Hi, everyone. It's great to see you again. And to our newest friends, welcome. I'm so glad you've joined us. My name is Sarah Yao Schutzman, CFA. I'm a managing partner of Providence Heights Capital Management, a hedge fund investing across the capital structure based in Chicago. I'm a co-founder and president of Collaborative WIM. Since 2019, I've served on the board of CFA Society Indianapolis and as a CFA Institute Research Challenge judge and grader. In 2020, CFA Society leaders around the U.S. created Collaborative WIM with our shared mission in mind, to further inclusion and diversity and the advancement and development of female leaders of all backgrounds. Like you, we believe that inclusion and diversity will allow our industry to achieve better investment outcomes. But more importantly, we believe it will better serve our diverse society. And so we're grateful to the leaders around the world who dedicated their incredible talents, time, and endless passion to our shared vision. Today, Collaborative WIM is a global alliance of more than 90 CFA societies, FPA chapters, and industry groups across the US, Canada, Caribbean, EMEA, and Latin America. Together, we work to amplify the critically important inclusion conversation wherever in the world it takes place. We created this community to facilitate a geography-agnostic exchange of ideas and a celebration of diversity in all its forms. Diversity of thought, of perspectives, and of backgrounds. In time, we hope that our efforts will both inspire and expand the female and diverse pipeline into the investment industry, as well as support their success. I'd like to thank Rupal Bhansali for joining us today, for a unique discussion, and for sharing her perspectives. Our hosts at CFA Society's Okanagan and Saskatchewan for their leadership of our collaboration, and Collaborative WIM's sponsors and allies who enable our work toward deeper, more meaningful conversations. We are so proud to work alongside all of these leaders to play our part in furthering the global diversity dialogue. And with that, I'd like to introduce my dear friend and Collaborative WIM co-founder, Ariel for a few words about today's interactive program.
Thank you, Sarah, and good afternoon, everyone. My name is Ariel Bitoni, and I am the Programming Director for Collaborative WIM, and also the Chair of the Women's Community Group of CFA Los Angeles. We are all very excited for our program today featuring Rhupal Bhansali. And as Sarah mentioned, we'd like to give a special thank you to our host societies. Thank you so much for your support with our program today. We're going to be headed into our first breakout room discussion session shortly, where you'll all have the opportunity to connect with your peers from all over the world. And given the topic of today's presentation, we have an icebreaker question to kick off your discussions. And it is, how do you feel about investing in Apple stock today? Are you a buyer or a seller? As you start to think about that question, we're going to go ahead and initiate the breakout sessions, and we will see you back here in about 10 minutes.
All right, I think we're mostly all back in the general room. Welcome back to the main session. I feel like those breakout discussions always seem to fly by, but hopefully everyone had the chance to make some new connections. I'm Christine Tinker, co-founder of Collaborative WIM and Senior Global Equity Portfolio Manager at Northern Trust Asset Management. We have a great program ahead, and I'm honored to introduce our esteemed guest today, a respected and incredibly talented and inspiring figure in our industry, someone who has achieved great success and pays it forward, as evident by her enthusiasm and thoughtful preparation for this event with us. Rupal Bhansali is a first-generation immigrant and woman of color who came to America with no network or net worth, but managed to break through the glass ceiling on Wall Street to become a chief investment officer. She is a serial entrepreneur who built and grew 3 multi-billion-dollar international equity businesses, first at Oppenheimer Capital, then at McKay Shields, and now at Ariel Investments. Throughout her 25-year career, the mutual funds she has managed have often received the coveted 5-star rating from Morningstar, which reflects top decile performance. She's been featured in the Barron's list of top 100 most influential women in US finance. She is known to be a contrarian investor who literally wrote the book on non-consensus investing. And now for a glimpse of her unconventional approach to investing, we welcome Rupal to present the power and payoff of non-consensus investing.
Thank you, Christina. I'm going to kick it off with a presentation for about half an hour to give you a peek into this counterintuitive but lucrative investment philosophy, one that I have implemented for the last 30 years of my career. And after that, we'll take some questions. So allow me to share the screen so we can kick this off. Thank you. And here we go. You can see it now. Okay.
Yeah, we can.
So obviously, there's been a lot of debate about the value add of active investors. The track record certainly of a lot of active managers, and I'm certainly one of them, has been demonstrated to be quite poor. And I'm about to share with you how it does not have to be that way. I think there's a very important role for active. To me, it means you don't have to toe the line and take the consensus point of view. If you're a non-consensus investor, there is a way to beat the market. As I sort of thought about this investment philosophy of mine, I wanted to share with you a central aspect of it, which is the and proposition versus the or proposition. You obviously see it all around you. When you use the iPhone, which many of us do, and you think of Steve Jobs, one of the things that non-consensus people do, the ones who are trying to change the game, is that they think outside the box. And one of the things that Steve Jobs did with the Apple iPhone is that he made sure that it was both smart and simple. Typically, if you had to figure out technology, you had to be a nerd. And he sort of refused to settle for that suboptimal compromise. He thought a phone can be smart as well as simple. And of course, we all know the power of that and what it has led to, not just for his company, but for all of us as individuals. It was absolutely a game changer, and we'll never go back, to the way life was before the and proposition was made real for us. When you think about, not just Silicon Valley, but you think about the world of sports, Billy Beane comes to mind. Obviously, you all know the success story as reflected in the book Moneyball and in the movie by that name. But essentially, the way Billy Beane changed the game of baseball and frankly, the business of baseball is he refused to accept that you had to pay up for talent and lose money and games. He changed the paradigm. He showed us how you can have above average wins at below average cost. So this and proposition is very hard to pull off, obviously, but it's been demonstrated in many spheres. And I just gave two examples here in Silicon Valley and sports. And it should lead us to think, because it led me to think, why not apply that sort of paradigm in investing? We are often told that if you want to have high returns, you have to accept high risk. Or if you want low risk, you have to accept low returns. And I didn't want to accept that suboptimal compromise. I wanted both higher returns and lower risk. So how do you crack the code of doing that? Because obviously that's a holy grail that everybody's after. That's what I'm going to share with you today. Before I do that, one of the things that people don't realize is what is so different about investing and why so many people actually fail at it. Clearly, I mentioned you the track record of a lot of investors suggests that they fail to beat the benchmarks, is because we tend to confuse the distinctive attributes of investing compared to things in life. For example, in life, if you're correct about something, you're off to the races. If you're a student, you get the right answers. That's great. That's good enough. If you're a lawyer, you quote all the right precedents in a lawsuit. You're probably going to win the case. So being correct is enough in all spheres of life, except investing. If you are correct, but your correct view is not non-consensus, it won't give you any money. Think about it. If you think Apple's going to report $10 of earnings and it actually reports $10 of earnings, you're probably correct. But the stock already reflects that expectation. There is no money to be made by being correct. So when investing, to beat the market, you not only need to be correct, you need to have a non-consensus point of view, which means your correct view is not shared by everybody else. And in fact, not only do you want to be correct, you want to prove everybody else's view incorrect. By the way, that's a lot of fun, right? Not only to be right, but to be able to prove that everybody else was wrong. So it's fun when you get it right, but that's kind of what it takes. So that's the important distinction. It's not enough to be correct. You have to be non-consensus as well. The other thing to keep in mind is it's really important to not be incorrect. In most other things in life, if you're incorrect, maybe the stakes are not so high. But in investing, if you get the answer incorrect, God help you, because you can end up losing a lot of money. So differently put, why the sport of investing is so difficult is because if you're correct, you may score no points, but if you're incorrect, you may incur penalty points. So that's really the asymmetry of investing. And so how do we make sure that we get things correct and we don't get things incorrect? That's sort of the art of fundamental research, the art of stock picking, and that's what I'm going to discuss next. I mentioned to you that, a lot of investors obviously try to beat the market. And the other thing that you'll find when you talk to any money manager or even an investor, they will always tell you, oh, I want to buy great quality companies. Obviously Warren Buffett made that a very popular concept, just by franchise quality companies, whether it's a small cap investor, a large cap investor, growth investor, value investor. I mean, you'll hardly hear anybody talk about, gee, I want to buy crap, right? I mean, it's always about, I want to buy quality. So how is it that if everybody's buying quality, they're still not outperforming the markets necessarily? Well, here's the tip-off. If you can understand quality well, you can secure big payoffs. And that's really, what you want to do. But if you misunderstand quality, you can incur a big penalty with that wrong answer. And here's where the trick in the market comes around. Quality, high quality can often masquerade as low quality, and low quality can masquerade as high quality. And if you don't know how to distinguish between the two, you can either have a huge blow up in your portfolio, because that's what happened when you think something is high quality, but it turns out to be low quality. God help you, you're going to lose a lot of money. But on the flip side, if it's low quality masquerading as high quality, you can actually lose a lot of money too, because again, that's not going to play out in practice. And over time, the market will be efficient in figuring that out. So that's sort of, what you really need to figure out is this notion of what I call false positives and false negatives. If something is actually masquerading as low quality, but is high quality, by owning it, you can make a lot of money because the market is pricing in poor outcomes or poor prospects, and the opposite can happen. So let me give you sort of a case study to bring this alive. Think about, the tire industry. Obviously, we all know what a tire does. Generally speaking, it's been around for what, like, many, many decades, close to 100 years. It's not a new phenomenon. Ever since we started driving cars or even having horse carriages, tires have always been required to go from point A to point B. And generally speaking, therefore, people think it's just a pair of wheels. It's a low-tech commodity product. And generally, I mean, I don't know if you've been in the market for a tire or a set of tires, it can still cost you a pretty penny, right? I mean, it's $1,000 often to replace, your set of tires in the car. So there's still a high sticker price, obviously costing you sometimes more than even a laptop nowadays. And traditionally and generally speaking, being an auto component kind of sector, company, it's been a low return on invested capital. I mean, many manufacturing industries tend to be that way. And again, if you assume that it's a low tech commodity item, the returns on invested capital are going to be pretty low. And generally speaking, the thesis tends to be that as the auto industry goes, so should the auto component industry, aka the tire industry. And if new car sales are down, therefore the fortunes of tire companies will suffer as well. Now that's conventionally sort of been the consensus view. What if, based on your research, you understand this to be incorrect and therefore not as low quality as the market is assigning to the tire industry? I'm here to tell you that based on the research that my team did and I did, we actually found that the tire has become a super mission critical component in the car because it actually contributes to both fuel efficiency and the safety, two very important attributes to a consumer when they buy a car. And obviously, from an ESG standpoint, as you well know, fuel emissions, are a very big contributor to greenhouse gas emissions. And if you want to improve on climate change and reduce those GHG, if you have a better performing set of tires, you're actually going to improve that fuel efficiency and therefore that emissions. So again, directly and indirectly, it's become an extremely mission critical component. Even as you think about the future, as we all are going to move into, say, electric vehicles or even autonomous vehicles, the one thing that does not go away and does not get obsoleted, even as many other car parts will get obsoleted, is the tire. You're still going to need a tire, whether there is a driver in it or not, whether there is an electric engine and battery inside of it. And so this is, again, something that, that one of the litmus tests of quality is, does it have longevity, or is it going to go obsolete? And I think it's clear the tire is not going to get obsolete. If anything, the tire becomes even more critical as you go into autonomous driving, because there you want to really solve for accidents and making sure that, this braking distance of the car, I mean, the moment you witness an obstacle, you're braking the car immediately. And that requires a very good tire, because a safety metric of a tire is determined by how quickly, the shorter the distance of the braking, from where the car comes to a full stop. That's supremely important. So again, the tire is becoming much more high tech, much more differentiated. It's not a commodity product. Not every tire company can actually solve for these things, which are, by the way, mutually exclusive. Remember that AND proposition I talked to you about on the first slide? The AND proposition of a tire company's mission is, in order to improve fuel efficiency, you don't want the tire to grip the ground too much. If it grips it, you're going at slower speed and you're actually consuming more fuel. But on the flip side, in order to improve the safety profile of the tire, you want the tire to grip the ground very, very quickly, right? So you're supposed to come up with a surface material that both does not grip the ground and grips the ground, right? It's like you can't have either or. You can't have higher fuel efficiency and lower safety. Nobody wants that. You want both. So that is the puzzle that only a few companies are able to solve for. Just like, again, for the smartphone, anybody could have had the idea, but to execute on it, it took someone, to come up with it and to solve for the end. That's what a good tire company has done. And if you're able to do that, actually, you don't have to be a low return on invested capital company. You actually get pricing power because you're able to differentiate and you have a very strong value proposition. You can have much better economics. And so, yes, in the past, when we didn't have all these trends in the marketplace and we were driving, regular passenger cars with regular tires, none of this was that important. A Me Too commoditized tire from the Chinese company in the 16-inch diameter market was just good enough. But going forward, that's just not the case. And companies get to differentiate and their economics will improve. And the last point, which was misunderstood by the market, is the tire industry is actually not dependent upon new cars sold. Frankly, it's a razor blade model, where the new tires in the new cars don't make you much money. They're the loss leader. It is when you go in the replacement market, which you typically have to do every couple of thousand miles, every couple of years, otherwise you won't meet inspection, of course. And there, what is the driver is it's a miles driven rather than a new car sold. So it doesn't matter that of late, we're not able to get our hands on new cars. It's really the used car market, but as long as you're going to increase your miles driven, which, in a COVID world, we are certainly doing that. Frankly, instead of taking public transportation, we are driving individually a whole lot more. That's actually very good news for the demand cycle and the replacement cycle of tires. So having now identified for you how something that was misperceived, misdiagnosed as low quality can turn out to be high quality, and that exception to the rule is Michelin, which is the company I'm talking about, you can see the kind of payoff you can get in the marketplace, the blue line being the stock price of Michelin and the red line being, the benchmark. You had roughly, over 2.5 times the performance that you can generate compared to, again, the index. So this is how active managers can beat the passive benchmarks through superior fundamental research, both which is correct, but equally important, non-consensus. So there's a big payoff that you can have. Now, I want to share with you the flip side of, how instead of making money, if you misdiagnose the quality on the other end, you can actually lose a lot of money, and how to avoid doing that. Because I told you there are big penalties for those wrong answers, and we don't want to incur big penalties. So I'm going to talk about another iconic company back in its day, which is, yes, the BlackBerry. I know many in the next generation, maybe not in my generation, don't even know of its existence. But let me tell you, it was the iPhone of its day. In fact, the code name for the BlackBerry was Crackberry because people thought they could not do without it. They were addicted to it. And back then, and I'm talking about a decade ago, it was perceived to be a very high quality business, a high-tech company. They had a QWERTY keyboard. It was extremely easy to get push email. Again, back in the day, a lot of the usage of the phone, the smartphone, tended to be email and data. And it was a very superior experience because you got your emails come through much faster than any other technology because they had an NOC in Canada and that compressed emails. And at a time when the networks did not have a lot of bandwidth capacity, they were designed for voice, not for data. And a lot of our phones were used for data, essentially emails coming through. That was a superior user experience and people really counted on it, including, of course, the US government for the security, etc. And again, given the success story that it was, people thought it had secular growth all over the world, not just in the US and in developed markets, that there were multiple opportunities ahead of it. And therefore, this sort of competitive advantage was allowed, the stock to trade at a very hefty multiple because of these expectations built into it. Of course, as time passed, what really happened is the market's view changed on it. Instead of being perceived as a high-tech company, which it really never was, it was really a consumer electronic company. It was a device, and consumer electronic companies typically tend to be hit or miss. And that's kind of what, that BlackBerry proved to be. When the products were a hit, obviously the stock was a hit, but when the products proved to be a miss, they did not generate the kind of outcomes that the stock market was expecting. And what once upon a time was a superior user experience proved to be an equivalent, and then of course over time an inferior one. And then obviously what was supposed to be a growth company turned out to be X growth. What was supposed to be an opportunity turned out to be a threat, and et cetera, et cetera. So again, something that was perceived to be high quality turned out to be low quality, and the market, frankly, owning that stock lost a lot of money. So I wanted to segue into, what about today, right? We all think of Apple as this iconic company and one that has delivered obviously great value for consumers. And of course, it has been reflected in the stock price. Could Apple be the next BlackBerry? It's a question that people don't think about. And I thought I would put it on the table. And hence, of course, your breakout sessions focused on that topic. So let me give you the consensus view, and then I'll share with you a potential non-consensus view to consider. Obviously, Apple is viewed to be a high-tech company. It's trading as if it's a technology stock on almost 30 times plus earnings. The user experience, it's hardly something that is a surprise to you. People think of it as extremely good. People love their iPhones. The user experience, the user interface is beautiful. And obviously, it's priced, as if it's got secular growth with multiple opportunities in the App Store, et cetera. That's where the company keeps talking about having pivoted, not to mention all the different devices that they've tried to come up with, whether it's the iWatch, it's Apple TV, it's Siri, whether it's applications or its products, iHome, these are the things that people thought would give it multiple opportunities. And clearly, there is a perception in the market that it's very competitive advantage on the back of all these developments that have happened in the past. If I were to give you a different take on this and say that, frankly, BlackBerry and Apple have a lot of parallels. Ultimately, the fortunes of the revenues and earnings of Apple are still reliant, frankly, on a single product. Yes, they have the Mac Air, they have the iPad, they used to have the iPod, iHome. When I even mentioned that, people roll their eyes, what is the iHome? And that's kind of my point. Those stories, those particular consumer electronics products, were misses over time as opposed to hits. And they don't even hit our consciousness because we do not think of anything other than the iPhone. But to keep in mind that even iTV, all these new things, iWatch has been a semi-success, but nowhere near the expectations people had for it. But many, many other initiatives, like even Siri, have frankly not lived up to their potential. And so they've had more misses, frankly, than hits, except for the fact that this flagship phone has done extremely well. And through COVID, it accelerated a trend that was underway where we're reliant even more on our electronic gadgets. But make no mistake about it, it is still an electronic item. It is not technology in the way one thinks about technology. And in terms of its superior user experience, there used to be things that they would do in their phones that were at the leading edge, whether it was in camera pixelation, whether it was a screen size, whether it was Gorilla Glass, all the things, that we sort of used to associate as unique to iPhone. You'd be surprised to know that even a mid-end phone in China, and certainly, the Galaxy phones or the Android phones, from a feature perspective, have not only matched but exceeded what Apple iPhone offers. But again, the brand perception is so high that people have kept on replacing their existing phones with the same ones. With the same brand, but from a technological perspective, the differentiation that used to exist is narrower and narrower, if any at all. And frankly, therefore, it begs the question whether the phone should command the kind of premium pricing, because typically in the marketplace, if you don't offer more, you shouldn't be able to charge more. Again, for a while, you can get away with it, but over time, it's extremely hard to keep up with that. If anything, you have to lower prices, not raise them. And therefore, if the replacement cycle, which is very critical, if you keep your iPhone for longer, remember it's a product, instead of replacing every 2 years, which has sort of been the trajectory, or even 18 months, say you replace it every 4 years. So I'm not saying that you'll give up your iPhone, you'll just keep it for longer. I certainly am able to keep my iPhone for longer, and I think many people might be able to. In that case, the revenues from that product just half, right? Nothing changes. The volumes are in half, therefore, because the replacement cycle went up 2x. And that's a very big hit to revenues and earnings, and that can prove to be a very big threat. And instead of being able to raise prices, what if it has to lower them when a product cycle does not succeed, like it had to do a couple of years ago when the stock sort of derated to a multiple of 13 times. And of late, of course, the multiple has gone up, as I said, to 30 times. So these are the kinds of things that could happen. And if that were to happen, I just wanted to allow you to imagine, this is sort of the stock price chart in red of Apple, and it's juxtaposed against the stock price chart of BlackBerry. I leave it not to your imagination, but just to see it on this page itself, the parallels, that are there between the two stories. What has gone up, if it has gone up for reasons that are not going to last, it can come down just as much. And so this is a kind of research, that you want to make sure you do. And the importance of that is really these penalties that I talked about. And this is crucial to keep in mind. If you lose 50%, and it's not unthinkable to lose 50% on a stock, let me remind you, you don't just need to go up 50% to break even, you need to go up 100% to break even. So minus 50 and plus 50 doesn't work out in investing. And the reason for that is, you start out with $100 and you lose 50%, you're at $50. But you make 50% only on that $50, which is to say, you always make money on a lower number, the $50. You lose money from a higher number. And that is sort of, again, simple arithmetic. But imagine if you made 50% on $50, you're at $75. You're nowhere near break even. In order to break even, you need to go up 2x, which is 100%. And let me tell you, it's very hard to come up with 100% winning ideas. Better not to lose the 50% in the first place, so you don't have to, scramble. What if you only lost 20%? Therefore, your $100 went to $80. And now, with that same 100% winning idea, that $80 can go up to $160. Not because you had a different 100% winning idea. Remember, the winning stock remains the same. It's the fact that you lost less on the losing idea. And that's the non-consensus thought I want to leave you with, which is avoiding losers is far more important than picking the winners. And this is why people think, oh my God, I had this great stock and I did so well. How come I'm net behind? Well, it's because you had a bunch of losers. This is how it plays out in a track record. Imagine I showed you a 10-year track record, which is a pretty good time, to judge performance for any manager. And over that 10-year period, all you knew is that this manager had a 7.2% gain, whereas a market, the benchmark, only grew 3.8% during that period annualized. That's a 350 basis points of outperformance, which is remarkable for an active manager, annualized. If I then showed you the interim period of 10 years, as opposed to this end state of 10 years, this is how it could look like. And this is kind of, the aha moment. On the previous slide, people say, I definitely want to give money to the manager. But when I show this slide, they will say, oh my God. Now, if you zero in, I've shaded the green shaded section is the years in which the manager outperformed the benchmark. This is very typical way in which people look at performance. They look at it year by year, in year one, year two, what did you do? And remember, in this 10-year track record, 6 out of the 10 years, the blue shaded section, this manager has underperformed. And if you just see that top portion, you're going to say, get rid of this manager. The batting average is terrible. Like more times than not, this manager underperforms the market. So how is it that even though this manager underperforms the market for more times than less, net, they still end up sitting so ahead of the benchmark. The two statistics are not inconsistent. They're actually very consistent in terms of beating the market. There's no typo there. This is real. Here's the way to look at that same performance, and that is in absolute terms, not relative terms. More people make the mistake of looking at performance in relative terms, -5, -16, +25, +35. That's all they look at. That is not the way money compounds. If you start out with $100 and you only lose 5%, you're at $95. Whereas with the benchmark, when you lost 16%, you ended up at $84. And again, the same thing continues. You can have, a bear market for a couple of years, and this is kind of where you end up. Now, because in year 3, even though the market goes up 35% and you only go up 25%, that's a whopping 1,000 basis points behind, you're sort of like, oh my God moment. Well, guess what? Because that 25% was made on $88, whereas a 35% was made on $68, you only end up at $92 at the benchmark and $110. See, you're already beating the benchmark because you lost less, even though you don't have that same winning idea or set of ideas. You don't actually need to beat the market by going up more than the market. You can beat the market by falling less than the market. That's the aha moment that I want you to have. And as you fast forward, despite many years of underperformance in the interim, the lead that you've developed never goes away. $127 higher than 106, 140 higher than 119. You can actually have a couple of years of underperformance in big bull markets and still not suffer for it, including, at the peak of the bull market, which is again, before the market crashes almost 42%. And this portfolio holds up better. But even prior to that, at $192, you're still ahead from $162. And so you've absolutely appreciated capital by 92% compared to 62%. And then, of course, that mega bear market, which I would say every decade or so, we are more likely to see, if not, I would argue is more likely to be around the corner than not. Be careful if you have a lot of losses in your portfolio, because it'll be extremely hard for you to make up for them. And in this particular strategy, you see this manager lost only 25% in the worst of the bear market into the 42%. And this is the aha moment. After 8 years of being in the market, you are actually behind. You may as well have put money in the mattress as opposed to even investing, in passive benchmarks. Whereas with this active manager, who again made money during the bear markets more so than, did not keep up in the up markets, but definitely protect on the downside, you actually had 45% more money in your account than the benchmark, where you actually lost 6%. So I hope I've demonstrated to you this importance of winning by not losing. Conventional wisdom in the markets is that you have to pick the hot dot, pick the hot stock, and that's what everybody tries to go towards. And I would tell you that if a lot of the good news is already in the price, in that hot dot or hot stock, you can actually end up losing a lot of money. Beware of that crowded trade. It's often the lonely trade, the contrarian trade that can be more profitable in the long run. And in performance terms, you don't want to make fashion statements. You want to make performance statements in your portfolio. So with that, in my book, because it's extremely hard to cover all the details and nuances, I've sort of written up this way of investing in much more detail. And this is kind of why I wanted to showcase for you how you can be a better stock picker, how you can think about passive and active in a very different light than what perhaps, the headlines have suggested for you. And that X factor of really, figuring out how to beat the markets, that which is the mother of all mistakes or the motherlode of all opportunities, is how to diagnose quality. And if you can diagnose it well and prove that the diagnosis of the market is wrong, you can make a lot of money or end up losing a lot of money, figure it out. And then, of course, I wanted to make a special call out because and this vision of WIN and myself is really, how can women be better stewards of their capital? How can they be better in terms of managing their career and learning about money, earning more money, and hopefully therefore managing it in the ways that I've described. I would very much encourage you to read that last chapter. And don't worry, you don't have to buy my book to do that. It's available on my website for free. Just go to nonconsensusinvesting.com and there is a section there called the book excerpt. and you can read it. It's all of 10 pages, but chock full of advice in terms of what has worked for me, and hopefully it might work for you. And with that, I'm happy to take questions. Victoria?
Yeah, thank you so much, Rupal. Thank you. Your presentation was truly eye-opening, and I think a lot of people have learned a lot from it. And right now we're gonna just turn into the Q&A, and it's your opportunity to ask your question directly from Rupal, or any other topics you'd like to discuss about her book, Non-Consensus Investing, or maybe even the last point that she brought up about more for personal development and career advice for women and young professionals. So if you'd like to ask a question, you can use raise your hand function on Zoom, and that way you can ask your question live. Or alternatively, you can also just type your question in chat and I will read it out loud. But as everybody is lining up, Rupal, why don't we just kind of start? I think it was a very good overview and very interesting concepts that you bring up. But kind of just to take a step back and think about your non-consensus view on the current market environment. What is it, in the current environment with tightening monetary policy, inflation, the correction we've seen in the technology space? What do you think about all that?
All right. Well, I told you that, it's really important to manage risks and not just returns. And to me, risk is losing money, plain and simple. And so here are the 4 ways to not lose money in the market. And that's sort of, the 4 L's to avoid losses. One is, please try not to own loss-making companies. I know they sound like great concepts, but concepts are not companies. If you are really a very sophisticated investor and know how to do research, that may quite work out for you. But in general, as a matter of routine, I avoid loss-making companies, and I would suggest you do the same. And those are most vulnerable in this market, which is reassessing risk. The second L is be very careful of owning companies with high leverage. Leverage is debt. A great degree of indebtedness has seeped into the corporate sector because interest rates were falling in the last decade, and it made sense, for a lot of CFOs to perhaps borrow what they deem to be cheap money. But I want to advise you that low cost is not the same as low risk. Just because, you don't have to pay a high interest rate, that's what a lot of people thought when they were getting HELOCs, in the residential boom of 2007, or interest-only loans. They thought, gee, you know what, I don't have to pay an interest, or it's so cheap. Well, you still have to repay the debt, and that's a big liability, and that's a big risk. And so I would be very wary as an equity investor to own companies with high leverage. The third L is lofty valuations. That can be a source of big losses. And I think you know what I'm talking about. There are many stocks out there where people feel they can pay up and up. And frankly, that's what causes stock prices to go up, not the fundamentals of the company improving in terms of earnings growth and cash flow growth. It's a P multiple re-rating, just because people want to pay more. Apple, I'm sorry to say, but is an example of this. There was a time when you could buy Apple stock on 13 times earnings. Today, you have to pay close to 30 times. Lofty valuations matter. The stocks have to justify that kind of multiple with even better earnings growth and better prospects than is priced in. And the higher the bar to cross, the harder it is. And the higher the bar that you can't cross, the harder you can fall. So again, a potential source of losses is lofty valuations. And the fourth one, which is perhaps not as well understood in the marketplace, but one that I would want to flag, is liquidity risk. Illiquidity has not mattered. When money is flowing into the markets and you're not trying to take money out of the markets, whether it's private equity, whether it's leverage loans, whether it's a lot of illiquid asset classes, including, I would argue, equities, it's fine not to worry about it. But you've seen episode after episode when people actually go for the exits, redemptions, whether it's in mutual funds or even ETFs, or even in the stock market during March of 2020 COVID, when everybody tried to withdraw their money, prices just gapped down. It was the fastest loss in the shortest amount of time. And that's because there is not enough liquidity in the markets unless the Fed backstops it. And I'm not convinced the Fed is interested in backstopping the markets anymore. They have a different priority now, which is inflation busting, and we may well be the casualties of it. So sorry, 4 different risks out there, all of which point in the same direction. Watch out. There is, of course, opportunity in the market, not just risk. But your question was, what are the risks that I'm looking out for? And that's kind of my response.
Thank you so much. Very helpful. And it seems like fundamental values, right? Fundamental truth that we have all learned about. Leverage is bad, but people just forgot about some of those concepts in this environment that was just fully risk off. And so I think it's time to bring some of those fundamentals back into your decision making. So thank you for pointing those out. And I see that Ariel has a question. Ariel, would you like to take yourself off mute?
Yes, thank you, Victoria. Rupal, thank you so much for the presentation. It was, Victoria mentioned, very eye-opening. It was very informative, and you really know your stuff. So my question kind of pertains from that, with how informative and eloquent the presentation was. If you were to think back in time and give either yourself or someone who's earlier in their career a piece of advice, knowing what you know now, what would you say would be kind of one of the most important things that you would share with them?
So in terms of managing one's career, or in terms of investing lessons?
Oh, okay, be more specific. So investing lessons. Both answers would be great, but I was thinking more on investing lessons.
Actually, I'll repeat what I just said. I wish I knew how costly it was to make investment mistakes. So you're going to make them, that's for sure. Don't let them be costly. So everything that I said in terms of, don't think about investing as about making money. It's also about not losing it. So if you don't know what's going to go wrong in the business, don't invest in it. Don't just think about what can go right in the business. You got to think about what can go wrong. And I think that it takes a lot of research, a lot of analysis. That is why it's a full-time job. I do worry a little bit about people, thinking, because we've come off such a resounding bull market for the last decade without any major corrections or checkpoints along the way, that people are confusing luck and skill. And they think it's easy to make money and it doesn't take a lot of work or effort. Just go along the stock markets and in fact, just invest passively and you're off to the races. I think a lot of those precepts would be called into question. Remember, if you invested in Japan in the 1980s, even if you went passive, you ended up losing a lot of money. You can have a 25-year bear market, things that people are simply not prepared for. The conventional wisdom is that markets only go up. And that's simply not been the case, except for the US, where it has been more the case than not. I cover 50 countries in the world, and I can tell you most of those 50 countries have not had that experience. So you should not base all of your research or theory on one country. There are 50 playbooks out there, and any one of those could materialize.
Yeah. Do you mind answering the question with respect to your career?
Oh, what I wish I knew before in my career. I didn't know the importance of this, but I sort of experienced it. And so I think this is what others might want to do. I think women in particular hold themselves back because they believe, and perhaps, we are ingrained in us to believe that we have to be good and we have to be perfect and, we should not make mistakes. And actually the biggest lesson I would give for anybody trying to manage their careers, especially women, is to make more mistakes. What that means is that you have to raise your hand and do things that you've never done before. And women are very afraid to do that. They always feel they need to be qualified. Somehow they need to know it before they do it. And I can tell you that was not my story of success at all. I didn't know anything. I wish I knew more. I didn't. All I knew is that, I was allowed to be very independent. My parents, I'm really lucky. They raised me to sort of make my own decisions, often. And when you make your own decisions and you don't have too many people to consult with or anybody to guide you, you end up making a lot of mistakes. And I did. And as long as the mistakes are not that costly, are not that serious, I think that it's really important to make them, because once you make them, instead of thinking of mistakes as misgivings, you start looking at them as opportunities for learning. Mistake is not a mistake if you make it an opportunity for learning. And that's kind of what I started to do. And more importantly, when you make that mistake, you're forced to take ownership of it, right? You're forced to sort of figure out, okay, what do I do differently the next time around so I don't end up in this pickle? And I think that's what I would tell women to do more of. Anything in your career, in managing your job, your life, put yourself out there. Because men do that all the time. They raise their hand even though they could muck it up. And often they do. But because they take on more, they learn more, and they do better the next time around. And that's all that we have to do. We do not have to think that we have to be perfect in doing something. It's okay to just do things and get them wrong the first time around, but learn from them and don't repeat your mistakes. That's my biggest career advice. Make more mistakes.
I think that's great. Thank you for answering both questions. Very, very helpful, Rupal.
Thank you, Ariel. And while we are on the topic of your personal career, Rupal, I was wondering if you could share a little bit more about your personal story. I think in your book, you describe how your passion became your profession. Could you just share a little bit more about that journey and how you came up with that realization and how you were one of those lucky people who actually can combine their passion and their profession?
Sure. I could also have said, it was necessity is the mother of invention kind of syndrome. I grew up in a family of bankers and brokers, and you might think that that's what led me to become an investor, and it's not quite that. For the full twists and turns of my journey, you probably need to read that chapter. I'm going to keep my remarks short in the interest of allowing more questions. But the short story is that, my dad was a stockbroker. And in the 1960s, which is when I was sort of born and growing up, the 1960s were a roaring stock market. Many of you were not alive back then, but I can tell you that was a worldwide phenomenon in India, which is where I grew up, was no exception. So he made a lot of money, things were good. And, that's when I was born, right? So he put me in a great school, everything was hunky-dory. And then the 70s came along. And I don't know if you recall about the 70s, they were a disaster in the stock markets, one of those lost decades. And especially so for my dad, who had started not just broking stocks, but investing our own family money into it. So taking principal trading risk, so to speak. And of course, the family fortune sort of ebbed and flowed, and the vicissitudes of the stock market became, the backdrop of my existence. If we had money, we could pay my tuition fees at school. If we didn't, we couldn't. And I would go to my mom, because again, I was put in a good school. So all my students and classmates had a lot of things. And I would go to her and say, I want to do this, I want that. And she would say, sure, we'll do it, when we have more money. And I was this 9-year-old thinking, okay, what is this mysterious thing called money? And why don't we have it? So my journey and learning about money and earning money came from the fact that I didn't have it. And I wanted to have it. And therefore, I started learning about money at a very young age. And before you knew it, what I did is just, keep walking in the direction of my destination. I didn't have a mentor. I didn't have a master plan. I didn't even know how to go about it. There's no such thing as financial literacy in curriculums in school. It's just same old, no different in my generation than sadly, even in today's generation. So this is kind of why I'm, so keen to pay it forward. I don't want anybody to experience what I experienced in my early life, in their later life, because they didn't manage their money well. It's not that I didn't have it, we lost it, right? So this notion of avoiding losing money, of putting yourself in a position, where standard of living has to go down a lot. People don't save enough for their retirement and often speculate with their money. So that's sort of become a mission of my life, to not let that experience play out for them, what I experienced, because I'll tell you, they might tell you that being poor is the worst thing that can happen to you. I'm here to tell you, no, it's not being poor. It's being poor after you have been rich. Try that. That's awful. And we are all leading well-off lives, but we don't know what it can be like on the other side. And I want people to understand that and to manage proactively to avoid that outcome. So that's my story.
Very, very interesting. And now I can see where that concept comes from of not losing is winning. So I think it goes back to your early life and your early experiences that became so invaluable, I think, in your personal career and your personal investing choices as well. So thank you for sharing that. And I see that Sarah has a question as well. Sarah, go ahead.
Hi, Rupal. It's great to hear your story. And it's especially inspiring to me because I'm a first-generation immigrant as well. So I can absolutely empathize with some of those experiences and agree that fear can be a very powerful motivator. So I think, having seen the success that you've had and the longevity of your career, obviously that doesn't come without perseverance and grit. So I'd really love to get a sense of, as you reflect on your career now, what are some of the things that you think you did very right? And what are some of the mistakes that you've learned from?
To be honest, I mean, that's why I wrote the whole damn book. It's just, I share everything that you're asking about in the book. And I'll give you kind of, two quick things. I think I made a very important decision in my life that I'm going to manage it by principles and not by goals. I didn't have the goal of making money to get into this profession, or I didn't have this goal of, gee, I want to work at this firm or that firm per se. I just knew I wanted to understand investing to its true potential. And that's kind of what I've done. That's very important because early in my career, I got a job on the sell side. And I really wanted to be on the buy side. That was a goal of mine, to manage money and to pick the stocks, not to pitch the stocks. But I didn't get a job on the buy side, so I ended up on the sell side. But I kept, letting my work speak for itself. And thankfully, my clients were buy side clients, and Soros, being a client of mine, liked my stock picking and stock pitching, I guess, because I would do research and give them ideas that suited, their investment appetite. And one day they picked up the phone and they said, you know what, we think you're good at what you do, and we'd like to have you come on this side. Would you be interested? And I was like, yay, finally made it to what I wanted, even if it was a bit of a detour. But the thing that I have not discussed, and people think it's easy, right? Like, I got this job offer and I made it. The tension in that job offer was it required me to take a 50% plus haircut to my compensation. I was good at what I was doing, so I was making a lot of money on the sell side, but I knew that the longevity of my career would be compromised. So the principle by which I've made decisions is the net present value of that decision, not the immediate payoff, but sort of the NPV of it. And even after I took that 50% payoff at Soros, I mean, I'm very happy I did it because my over the net present value of my career has been way better off than if I had been, on that side of the pond, which is not suitable to, again, what I wanted to accomplish. So that's the biggest thing I would tell you is, I know a lot of people say, make goals and go after your goals. And I don't know how to do it. I just know that every time I've had to make a decision, my North Star has been my set of principles, and that is one of them. The other principle that proved to be my North Star is in the late 1990s, I had a very pivotal decision confronting me. And that was in the late 1990s. It was a growth market, a raw bull market, a risk-on market, a market where you really needed to be passively invested in the ETFs and the triple Qs, NASDAQ. If you were an active manager, a fundamental bottoms-up risk-aware manager, contrarian manager, God help you. I mean, it feels like, the last couple of years, of course, but that was the context back then. And I was therefore not able to, I was actually telling my bosses back then to not invest in Asian emerging markets, which was the flavor of the month and flavor of the day. Asia was supposed to be sort of the miracle economy. And here I was telling, based on my own research and bottoms-up analysis, which was independent, fundamental, a classic misdiagnosis of quality. Here people are calling it the Asian miracle. And I'm telling my bosses it's the Asian mirage. None of this is true. It's not holding up to scrutiny. It's a gigantic bubble and a crowded trade. And, here's the reasons why and why it's going to come collapsing down. And of course, therefore, we were underweight Asian equities and everybody else in the world was overweight. And that was a very contrarian call. And I was really, likely at that time, because I was still an immigrant, of course, and, my visa was being processed by Oppenheimer Capital for my green card. And I think I was this close to getting fired because, I just kept having the stance, which was completely and utterly out of step with everybody else's. But again, it was based on the research I was doing. And thankfully, on July 4th, which I know is the American Independence Day, but it's also my Independence Day in some ways, because the Thai baht in 1997 finally, devalued and Asian markets came falling, crashing down like dominoes, and people lost their shirts. And we protected our clients' money by not investing in it, again, avoiding the losers and the losses. And we made our track record instead of losing it. Of course, I went from being zero to hero in my organization, but all that came later. I had to make this pivotal decision. Do I care about my job or do I care about my work? The two are different. And if you want to be true to your work, sometimes it can be at the expense of your job. And thankfully, the success came along soon enough. But I could have been sent back to India. I mean, I would have just been deported if I'd lost my job. That meant losing my visa. So the stakes are high. And when they are high, my recommendation to you is do the right thing.
Sometimes easier said than done, but well said. Thank you.
Thank you, Sarah. And we have a question that came in chat as well, and it's about coming back to that non-consensus and consensus thinking. I think the reason consensus exists is people, it feels bad to be right, but alone. But when people are wrong, but they're together and not alone, it feels sort of better. And so the question is from Michelle, who is wondering, how do you decide when to reevaluate your position or your decision? Because you can be right, but the market can be wrong for longer than you have capital. So what's your response to that, Rupal?
Sure. Look, story of my life. You're absolutely right. It's a lonely trade, and one where you're guilty till proven innocent, because everybody else has a different point of view than you do, and it's a very uncomfortable place. And even if you've committed no crime, you're doing the time, right? So it's just not a human condition, and so you really have to condition yourself, mentally. And that's kind of what I've spent a lifetime doing. The other thing that you have to, so two things, to help you get through whether you're right or wrong, or whether you're early and therefore, it's a matter of time, not a matter of thesis. What you want to track is not so much how the stock price is performing, because that can have a lag effect, obviously, but how the underlying business is performing. So when we were owning Michelin stock, that example that I gave you, for example, back in my day, I'm not suggesting you do this right now. I'm not trying to pitch a stock to you. I'm just trying to give you a sense for, early in owning the stocks that I've owned in my career, in the early days, you actually are always proven wrong. I mean, the stocks tend to underperform, but that's sort of giving you an opportunity to average down as long as you think that the business is doing better. So what we were tracking in the case of Michelin is, are they seeing design wins in the new cars? That doesn't show up in the financial statements. It's going to show up 3 or 4 years later, because, that's how long it takes to launch a new model design. It's planned very much in advance, but you can have those leading indicators of how the business is tracking. And we could see that they were winning more and more market share in design wins in the higher spec tires, in the higher spec cars, which means the mix shift was going to be better and better. So what you want to keep an eye out on are the fundamentals and the thesis tracking, what you're expecting to have happen, even if the stock price is diverging. And so that divergence can be a source of opportunity. But if the fundamentals are going in the wrong direction, even if the stock price is going in the right direction, right? Then you want to kind of cut bait and move on. So that's the way to kind of distinguish between the two. The other question I think you had is, how do you manage, this very lonely place that you find yourself in? Let me tell you, there are very few support groups because there are very few contrarians. And thank God for that, because if everybody became a contrarian, that would be a consensus. And, we don't want that. So it's a small niche. But what you can do is, there are people out there who are believers in this kind of investment philosophy, get to know them. And that's kind of why I gave, in a sneaky way, my email address in my book, which otherwise you will pretty much not be able to get on your own, because I tend to have a safe senders list. The second thing that you can do is try to work at an environment, with investors who think like, in this way. That becomes your support group. And the last thing, that you want to do is, I'm so sorry, guys, I'm in a Zoom call, believe. I'm so sorry. I've got back-to-back meetings and I must have been double booked, which is not good. But to finish by that thought, and I forgot what I was telling you about.
Managing that lonely place.
Oh, the lonely place, the support group, yes. What I suggest you do is manage the expectations of your clients, not just their money. When I talk to clients, I tell them that, I'm not serving what I call fast food. I'm serving fine dining. If you expect me to deliver the kinds of outperformance and quick speed, instant gratification, you go with another kind of manager, because the payoff that you get with my kind of investing money tends to be much more longer term. And I often will lose the battle to win the war. And that's very different. A lot of people try to focus on winning the battle and losing the war, which actually makes your client worse off. So managing your client expectations, going into it, letting them know you're not serving fast food, so they don't expect instant gratification, but fine dining. In the long run, that's better for your health, that's better for your satisfaction. In the short run, if you're hungry, this is always going to satisfy you, but at great cost. So I think those are the kinds of things that you try to do to solve things at the front end. But it's still going to be hard. I'm not going to sugarcoat it, but the payoff is amazing. It's far greater, and that's kind of why you do what you do.
That, I think, well said. And just wanted to thank you again, Rupal, for joining us today and for this wonderful presentation. I think it was amazing. It was a great introduction too in your book, actually, that I think a lot of us have already read, or at least that last chapter that encouraged a lot of us. So we are definitely looking forward to bringing you back again if you are up for it and discussing your book maybe in one of our next programs. And with that, I'm just going to say thank you again on behalf of all of us at CWIM, and thank you for being here with us today. And for everybody else,
for having me.
Of course. And for everybody else who is on the line, for our audience, we're going to have another breakout session right now. So you'll have another 10 minutes to network with your fellow colleagues and meet some new people. But while you're doing so, what we would like you to discuss today is actually the 3 things that you've learned from today's presentation that you will apply to your investment decisions or your day-to-day life right away. So as you are networking, remember that question and share your top 3 things that you've learned today. And we'll see you all shortly in about 10 minutes.
All right, looks like the folks are back. Hi, everyone. My name is Regina, and I am also a co-founder and a vice president of Collaborative WIM. So thank you for participating in our programming. I hope you enjoyed it. And we look forward to seeing you at our future events. So please sign up for our email communication, follow us on LinkedIn. I know the links were provided to you in the comments. And additionally, we do have a website, so you can find all of our upcoming events. We are hosting the next book club. Scott Miller will be featured with his book Master Mentors on April 13th, hosted by CFA Society Switzerland and CFA Society Atlanta. And if you have any questions, don't hesitate to reach out to any of us, connect with any of us. We appreciate you coming and being part of our mission and shared vision. Thanks all again.